Okay, so you listen to a lot of real estate podcasts, including this one, and you hear all these terms and you don't know what they all mean. Sometimes you're afraid to ask. Sometimes you think you know what it is, but you don't really know. Do you know what active investing is? Passive investing? What about private money? Those are things that we're going to hear about from Kevin Amolsch in this quick take episode of the Real Estate Law Podcast. Kevin is with Pine Financial Group, and we had a great conversation a number of months ago where Kevin explains what all those things are and how they factor into his everyday as he vets deals and works with investors to try to get them great returns on their money. After we recorded, Kevin invited us onto his podcast. I actually recorded with him probably a few weeks after we recorded the episode of the Real Estate Law Podcast. And when the podcast came out, somehow the title was, my name, Jason Muth, and how I won my down payment gambling. Something along that line. You'll have to look it up online. You can easily find it on Google. And it's kind of true. Like, I did win half the down payment for the first property that we purchased playing Let It Ride poker when I hit a royal flush a number of years ago. It's a really kind of cool story. We could have won $400,000 if I bet the progressive, but I didn't. So instead, we won about 15 grand and we put that toward real estate, and suddenly we're now real estate investors. I do not advocate for you to go gamble to try to win your down payment, but if you happen to get lucky, it's a great place to then invest that money, which is exactly what we did, and somehow it became the title of that episode. That is not what this one is about. We're going to hear from Kevin about what private money is and active investing and passive investing. So enjoy.
Like, can you explain what private money means when you're raising private money? Because again, this is a term that gets thrown around a lot in our space. Yeah, I think people nod along, but they don't really know what that means.
Yeah, because it can mean a couple of different things. Like, I get the question a lot, like, what's hard money mean? And look, there's no dictionary definition for this. This is just jargon that we use in the industry. So private money could be a couple of things. It could be literally private individuals funding your deals. So a lot of people, as you mature in the business, you'll go out and you raise your own capital from friends, family, colleagues, the RIAs, the bigger pockets, that kind of thing. And it's just individuals helping each other out, really. So the pricing can vary a lot because it's just two people trying to negotiate on their own behalf. But what gets interesting is there's actually an industry around this now. So when I got started, it was like a hard money lender is kind of rare to find. Now, hard money that term is trying to be recoined by some of the advocates in the industry. But all that is private money brought in by institutional type investors. So think about, I shouldn't have said institution because that could lead you down a different path, but think about a more sophisticated real estate investor that has access to private money, loaning it out to other investors. So they're charging fees basically, but oftentimes that's all private money coming into that hard money lender, and that's how they fund it. Answer the question.
Yeah, I mean, it certainly clarifies it a bit. Rory, I never liked the term hard money. What do you think about that, Rory? It just feels like, I don't know, it doesn't feel like it's hard to get. It just feels like a rock's going to hit you if you screw up or something. I don't know.
Yeah, it definitely feels like a pejorative for a certain aspect of private loans. Kevin, you said something there that you worked as a mortgage broker for a while, but you kind of ran up against the limitations of that role. And I kind of want to draw a line here for our listeners. What is the value of a mortgage broker? When is it right to work with a conventional mortgage broker? And when should you be looking at other options?
I think brokers are fantastic for your business, and this is going to go for brokering money. And when I say brokering, all you're doing is bringing two people together, right, and charging a fee for it. But if you're brokering money, it's huge because they have relationships that you might not have. And like in real estate, a lot, like if you're a real estate agent or real estate broker, those are super valuable to an investor also because they help find deals and have access to the MLS and all of this. So do you absolutely need a mortgage broker necessarily to be successful in the business? No, because you can build relationships with banks and private money and hard money that you guys don't like the term, but you could do all of those things, yes, but a mortgage broker has access to banks that have access to Fannie and Freddie money, and that's the cheapest money you can get. So if you're not working with a broker, at least have that tool in the belt. We talk about tools in the real estate investor tool belt all the time. You might want that tool. So I would definitely say that it's an important piece of the business.
Mm-hmm. Let's talk a bit about active and passive real estate investing. Before we hit record and we were kind of going over some of the topics for the podcast, you mentioned Wall Street versus Main Street and the difference between active and passive. So talk a little bit about that. Like, how can people understand active and passive? what are the differences between Wall Street and Main Street that we all live in?
Yeah, so there's two different things here. So we're talking about Wall Street versus Main Street. There's a lot of people, and I know this is not going to be aired today, so who knows what's going to happen by the time you guys post this, but there's a lot of people that think the stock market's in for a rough ride, and there's some volatility ahead and potentially some massive correction. Now, I'm not necessarily in that camp, but I understand that there's risk in Wall Street, right? Main Street, it just feels more comfortable to me. Main Street is like the house down the street. You can invest in that house down the street. That's why real estate investors, a lot of times why they're attracted to real estate over a Wall Street type investment. So that's one here. And then the active versus passive, if you decide to invest in Main Street and you want to invest in real estate, you could invest by owning the property, or you could be a more passive investor and either invest in somebody else's deal and be an equity player in that deal, or you could be on the debt side, which is where I play and where I love. The reason for that is it's totally passive and it's safer because debt is a priority over equity. So when we talk about passive versus active, it's just how much effort do you want to put into it? Maybe how much risk are you willing to take? Clearly, if you own the asset, if you own the rental property, the short-term rental, you have your tenants paying off your mortgage for you. You have the appreciation benefits. You have the tax benefits of owning the real estate. And you possibly can get some cash flow out of that as well. So it could pay higher to be active. Just how much are you willing to do for that?
Mm-hmm. Yeah, and it's hard to be an active investor if people are working full-time jobs and have families. The time is finite. So I definitely understand why people want to include some passive investments in their portfolios. So Kevin, do you work with people and then you connect them with passive investments and people that are raising capital, or what's your role in that process?
Yeah, I'm glad you asked that, Jason, because our business confuses people sometimes because we really have two distinct sides to it. We have money that we have to bring in from private investors. So that would be your passive side. So if you're looking for just, what do they call it? Mailbox money. If you're looking for that, that would be on this side of the business. If you are actively trying to fix and flip or buy short-term rentals or do some type of value add or repositioning, that would be the other side of our business where we loan the money out to you. Now, on the passive side, where I'm super proud of and excited is we got approved almost 2 years ago now. So I'm still excited about it, but it's been a little while. Our fund got approved to offer publicly. So now we don't have the restrictions of accredited versus non-accredited investors. And we can advertise a rate and promise that rate. So it's very different than most syndications or most other funds out there. So that's huge for us. So one way we could work together on the passive side is investing in a public mortgage fund with 15 years track record.
Mm-hmm. Passive investing in the mailbox money, I think for some people, it just isn't sexy enough, right? It doesn't have
Totally right.
Yeah, it doesn't have the glitz of pointing at your place, because oftentimes you're investing in a large property in a city that could be distant from you. So you're really just seeing it on paper, on a computer screen, and then you're collecting the money that was promised to you. And, we all know investors, people can get antsy, right? You're like, I'm going to do another deal, or
Yes.
You can't sit still. Where do you think some folks where passive investing might be a good idea for them? Where does it fit into their portfolio and their profile? Who are those people that have been your best customers, your repeat customers that appreciate what they're getting out of, a passive investment?
Yeah. So the best clients that we have on that passive side is people who are experienced in real estate because they know how safe it is. So think about your real estate agents or your real estate attorneys. We have a lot of those investing in our fund because they understand that we're at a low loan to value in a senior debt position. It kind of doesn't get safer than that, in my opinion, unless you're FDIC insured, and even that's in question recently. So real estate backed assets, those are the clients that enjoy it the most. Now, you're right, it's not sexy. We watch TV on HDTV and we see these fix and flippers and how much money they're making, and all of that is really kind of fun. And like you say, chasing the next deal, you go to the RIA and you could tell them I just finished 2 flips. That's fun. And that makes you feel good. One of my biggest mistakes in my career was setting goals around number of doors I own or number of properties or projects I wanted to work on. And I did that because I thought that it was impressive. So a little bit of humble pie here. What ended up happening is 2008, freaking took me down. So I think a passive investment for some diversification is for everybody, honestly.
Yeah. Number of doors is such a terrible metric.
I hate it.
I hate it. You know, Rory and I have talked about this. We've talked with other podcast guests about it. I think that we're part of the machine, right? We have a podcast about real estate and law, and we're talking to someone like you that's in this space. And I think that a lot of our forebears and people that have real estate podcasts always just talk about size and magnitude. And if you want to be an investor and you're getting on these podcasts, like I think you're more likely to get on a podcast when you have 75 doors than when you have 3, right? But so I think it kind of fed itself, like it fed the machine and the monster. But I just look at that as just a lot of work, you know, and it depends on where you are in your lives, right? Like Rory and I, we're a little bit later in our working careers, right? Like, you know, I at least am versus Rory. I mean, I worked for 25 years before I stopped working in a W-2 job, and now I'm just doing the investing. But if I was in my 20s, I could see myself, whoa, like accumulate, get the doors, like be the guy that goes to the RIAs and talks about your flips. Do 20-year-olds or 25-year-olds, like, are they investing in passive investments? Or is this like something where you see people later in their career, they're established, they have money to park, they want to get in the space, they don't want to leave their job yet? That feels like more of the profile.
I'm thinking about what you said, Jason, about if you were younger, you'd be chasing those doors. And I just think, why? Like, what's the point? Is it just ego? Or are you trying to increase your bottom line? Because there's ways to increase bottom line without just increasing the number of doors, right? So whenever I hear someone say, I own 1,200 or whatever, I've syndicated 1,200 doors or whatever it is, that's fantastic. Are you making any money? You know, that's what to answer your question about the passive side. Look, fix and flipping, this is an example. Fixing and flipping, we call you a real estate investor. And I happen to love fixing and flipping because I loan to those. I make money when you fix and flip, so thank you very much.
Right.
But that's just a job. Because as soon as you stop flipping, your income stops. So how do we call that investing at all? It doesn't make any sense to me. It's a high paying job, which is fantastic, but it's clearly a job. So my suggestion, and what a lot of the experts will tell you, is if you could take money out of your income and invest it for passive growth or passive income, that's how you're going to get rich. It's easy to get rich in real estate because it creates all these opportunities to invest passively. And then you could just keep doing it, right? Pull money out of where you're earning it and put it into a passive investment. That's the formula.
All right, there's another quick take with the Real Estate Law Podcast. For the full episode, go to YouTube or Spotify or iTunes or wherever you heard or listened to that quick take. We also have all of our episodes posted at realestatelawpodcast.com. So on behalf of Rory Gill, I'm Jason Muth, one of your hosts, and we thank you for listening.